Well, hello everyone, and welcome to Momentum channel. And today we are going to be talking about top energy dividend stocks to buy in 2022. And we are going to be taking a look at two undervalued energy stocks that are fast dividend growers and perfect for many investors to consider to buy or add to their watch list right now. Let's get into it. The first undervalued stocks in energy sector is a company called Canadian Natural. It is traded on New York Stock Exchange with ticker symbol CNQ and actually does pay a dividend, currently yielding at 4.51%. The dividend safety score for Canadian Natural is at 70, making it a safe dividend payer, and the company has a market cap of $48.2 billion, making it a large cap company. The last trading price at the time of making this video for the stock is at $42.07. And if you look at it, Canadian Natural was formed in 1973, and it in fact began its kind of history back in Alberta, Canada. The firm later then expanded natural gas production to British Columbia and added crude oil operation through acquisitions across Western Canada. Canadian Natural's large size and concentrated operations in Canada, which requires more travel to reach US, refineries may require more travel. And as a result of that, could make it difficult for the firm to adapt to a more rapid energy transition scenario. That being said, though, there are long-term predictions about energy, has a lot of uncertainty, which might be a little bit of concern for some of the investors worried about the future of oil and gas. Nonetheless, it is worthwhile mentioning that energy sector was actually the best performing sector in 2021 by the end of the year. And despite some of the kind of gloomy returns for the energy sector in 2020 last year, the stock markets and overall the sector in energy sector actually did very well. And many investors who consider Canadian Natural as a good option for investor, they are interested in more so around that reliable dividend payment. And let's take a look at that and kind of dive deeper into that. Looking at the dividend growth history for the Canadian Natural company, you notice here that they are showing that dividend growth of 25% in the last time that they increased the dividend, which was in November of 2021. 25%. That makes it a very fast dividend grower in that time frame. Well, if we look at a longer time horizon for the last 5 years, they are showing an annualized dividend increase of 13%, again, considered to be very fast dividend grower. And in the last 10 years, they're showing an annualized dividend increase of 19%, again, making it a very fast dividend grower in that sense. From a payout ratio for their dividend, they are showing 45%, which is a little bit edging higher for oil producers. In terms of their forward payout ratio, it's lower and it's only at 33%. And ideally, we'd like to see for dividend paying companies, their payout ratio to be hovering around 30 to 60% range. The lower, suggesting that there is a lot of room for them to grow their dividend payment. Looking at their annual dividends per share, you'd notice that the company has been paying its dividend uninterrupted for the past 19 years. And in all of those years, they've increased their dividend year after year. The company does pay its dividend on a quarterly basis in the month of January, April, July, and October. And currently they have an annual payout of $1.90. Next, we're going to take a look at the valuation. CNQ's current dividend yield of 4.51% is about 13% above their 5-year average of 3.98, indicating that the stock may be undervalued, unless you believe that the company's outlook has weakened. We're, of course, going to be taking like a number of other financial metrics. We're not just going to solely rely on the dividend yield and its comparison to the 5-year average. That being said, though, it is worth noticing that CNQ's forward price to earning ratio of 7.4 is well below its 5-year average of 12.5, and also well below that of the energy sector, which is showing to be at 11.1. From a price range perspective, the 52-week price range, you notice it is kind of trading higher, closer to their 52-week high price, which was at $43.59, and their lowest price in the past 1 year has been at $22.58. We're going to take a look at the number of other financial metrics to assess the company and its stocks a little better. These include earnings per share, the earnings per share growth, return on equity, as well as the total sales or revenue for the company. We're also going to be taking a look at the number of outstanding shares. And why don't we just get started there? Ideally, for the number of outstanding shares, we'd like to see a company that doesn't increase its outstanding shares in the market, but rather declines it gradually over time. In this case, it seems that they have been issuing new shares, and some companies, of course, tend to do that to raise more capital and cash. And in this case, although there has been increase, but it's not been like a drastic increase. In fact, for the most part, over the past 10 years, they have kind of maintained it at a flat rate in terms of the number of outstanding shares. As for the total sales, ideally, we'd like to see a nice steady growth. There is a little bit of that cyclicality and ups and downs for the total sales. For example, in the 2015 and 2016, you'd see that the revenue of the company dropped considerably, but it continued to pick up from there. And 2020 was another year that they kind of their revenue was down again, back to 16.9. But the last 12 months, the company is showing signs of recovery. And in fact, in the last 12 months, their total sales is at 25.9, which is the highest amount in the past 10 years. And that's $25.9 billion, by the way. In terms of earnings per share, which is a graph shown on the top left side, we'd also again like to see this consistent growth over time. Well, we do see some of that in the beginning. It is not always consistent. So there are some years, for example, 2016 or 2020, that the company was reporting a negative earnings per share. But in the last 12 months, they have reported $3.98 earnings per share, highest in the past 10 years. And the next 12 months, there's a projection of $7.20, again, the highest drastically over the past 12 months. Next, we're going to take a look at return on equity at the bottom right side. And ideally, for companies that are in oil producers, we'd like to see the return on equity above 10%. And the last 12 months, we are seeing that 17%, which is quite reasonable and remarkable for us in that sense. We are going to be taking a look at the stock returns. And for that, we have 1-year return and 5-year return. The past 1-year return on the graph shown at the left side indicates that the stock for Canadian natural resources was up by 72.29% in the past 1 year. The past 5 years, though, overall, they're showing a 22.65% return in the past 5 years. This does not take into account the dividend that the investors would have been earning to investing in Canadian natural resources. Next, we're going to be taking a look at some of the analyst estimates. First is by tip ranks. There are 14 analysts on tip ranks covering the stock, 11 of them having a buy rating, 3 of them having a hold rating, giving it an overall strong buy kind of consensus. The price target for the 1 year is showing to be an average of $48.30. And if that holds true, that shows an upside of 14.8%. Next, we are going to take a look at the analysts on Yahoo Finance. The 1 year target there is at $48.82. And lastly, we're going to be taking a look at the analysts on Simply Wall Street, whereby they talk about the valuation metrics and how undervalued or overvalued they believe the stock is and what's the fair valuation. According to analysts there, the fair valuation for this stock is at $71.88 USD. And given their current price, they suggest that the stock is undervalued by about 42%. There you have it. Before we continue to take a look at the second undervalued energy stocks, the fast dividend grower, I have a big favor to ask you. I've been putting a lot of time and effort to actually make this video and put this for you here. I really appreciate it if you can give this video a thumbs up and subscribe to our channel for more videos about investing and finances. Thank you. The second undervalued stock to review is a company called TC Energy. It is in oil and gas storage and transportation, and the company does pay a dividend of 5.87% annually. The company is traded on New York Stock Exchange and is available under ticker symbol TRP. Given that the company is actually originally from Canada, it is also available for kind of investors in Toronto Stock Exchange, if that's something that interests you. TC Energy actually has a market capitalization of $46.2 billion, making it a large cap company. And they have a dividend safety score of 61, again, making it a safe dividend payer. From a volatility perspective, the stock has a beta score of 0.72. Beta is a measure of volatility, and a score of 1 suggests that the stock has similar volatility as the overall stock market. In this case, as the score of less than that, or 0.72, suggests that TC Energy stock is less volatile than the overall stock market. TC Energy has their cross-country pipelines, and it is still actually remains in service today. They have businesses across all of its various businesses, including owning utility-like assets, and around 95% of their firm's cash flow is actually from rate-regulated businesses or supported by long-term contracts with fixed fee provisions and often minimum volume commitments. And this actually reduces the company's direct exposure to commodity prices and results in a predictable earnings stream. These qualities have helped TC Energy pay higher dividends each year since 2001. Speaking of the dividend, we notice that the company has a payout ratio of 48%, which is low for pipelines, and their forward payout ratio is 53%, still low for pipelines, giving it a ton of room for increasing their dividend payments. We're going to take a look at their dividend growth. In their last dividend increase was in February of 2021, whereby they increased their dividend by 7.4%. And also their dividend growth in the past 5 years has been increasing by an annualized of 9%. The last 20 years, they have increased their dividend 7% per year on average, but it makes it an average kind of dividend growth annualized over the span of the 20-year time frame. If they continue their kind of trend for increase of their dividend, you could possibly expect another dividend increase in February of 2022. Which goes to back to this other point that I wanted to make. The company has been paying its dividend uninterrupted for the past 20 years, and each one of those years, year after year, they have increased their dividend every year. They are paying their dividend quarterly in the month of January, April, July, and October, and their annual payout ratio is $2.79 per share. In terms of valuation, you notice that TC Energy's current dividend yield of 5.87% is 17% above their 5-year average of 5%, indicating that now could be a reasonable time to invest unless you believe that the company's outlook has weakened. Furthermore, their forward price to discounted cash flow ratio of 9.1 is close to its 5-year average of 9.2, and the market as a result appears to be valuing the stock similarly to how it has in the past. Looking at the 52-week price range for the stock, it seems to be hovering around halfway between the lowest and highest price range in that sense for the stock. Let's take a look at the discounted cash flow per share. And for those of you who are not familiar, discounted cash flow is a method of valuation used to determine the value of an investment based on its return or future cash flows, and it's commonly used for pipeline companies, in this case, TC Energy. And you notice here, as we indicated, that their the next 12 months is estimated to be at $6.71. In terms of outstanding shares, they have been issuing new shares, and the last 12 months, they are showing 963 million outstanding shares. It is worthwhile mentioning that pipelines return little cash flow due to their costly growth projects and high payout ratios, and some pipelines depend on issuing shares to help finance their growth, which can create challenges if their stock price is in the dumps due to weak investors' sentiments. In this case, the total sales for TC Energy has been actually growing nicely. If you look at it, for example, you notice that the last 12 months, they have reported $13.1 billion total sales. It is not as high as what they had in the 2018, which was at 13.7. Nonetheless, it's definitely higher than the range of 2011 to all the way to 2016, whereby they hovered from a low of $7.84 billion in sales to high up to 12.5. Lastly, in terms of return on equity, they are showing 6% in the last 12 months, and the 2020 they had their highest return on equity in the past 10 years at 15%. Let's take a look at the stock return. In the past 1 year, the stock was up by 14.88%. Not too bad at all. Definitely not as impressive as Canadian Natural Resources, but still a kind of decent return. The past 5 years, though, the story has been different. In fact, the past 5 years, the stock has fairly stayed stagnant and had was down by only a fraction of a percent at 0.15%, or down by 9 cents over the past 5 years. This does not take into account the dividend that investors would have gained. Let's take a look at stock price predictions. Based on analysts on tip ranks, and 16 of them, 6 of them have a buy rating, 9 of them have a hold rating, and 1 is sell rating, giving the stock a moderate buy. And the price projection is at $53.79, making the stock, if that holds true, an upside of 13.08%. Analysts on Yahoo Finance have a price projection of $56.42 in the next 1 year. And analysts on Simply Wall Street believe from valuation perspective that stock may be overvalued by 4.9%. Again, we are bringing this up because obviously you notice there are different perspectives and different projections by analysts, and we wanted to give you those concepts and different, viewpoints that are out there by investors. Many times, investors, when they choose to invest in companies such as TC Energy, is because of their solid dividend payment, and also the juicy dividend. In this case, was quite high, more than 5% annually dividend, and that's quite decent for investors to get in if they're interested in a solid in stream of income in that sense. I hope you found this video beneficial and gained something of value from it. If you did, don't forget to give this video a thumbs up and subscribe to our channel here on Moementum Finance. We post every week several videos about investing, whether it's investing in the stock market, cryptocurrencies, and real estate, as well as ways to reach financial freedom. Thank you, and we hope to see you next time.